Did Trump's new tax bill make your Social Security income tax-free? Whether you're claiming Social Security already or perhaps you're getting ready to soon, you've probably asked this exact question because that's what a lot of retirees think. At the end of the day, that is what he campaigned on. But here's the truth. Spoiler alert. Social Security is still taxable for many of you. But if you're 65 or older or turning 65 this year in 2025, you are getting a significant tax break. But how much? And will it actually matter for your retirement plans? In this video, I'm going to break down one of our clients who's over 65 with 1.5 million in retirement assets and how it impacted their tax situation for 2025. And we're also going to talk about 3 key planning opportunities for them and others who are in a similar boat. So we're going to dive into some screenshots from our tax planning software, Holistiplan. So first of all, shout out to Holistiplan. Literally the day after the One Big Beautiful Bill Act was passed, or better known as OBBBA, these changes were in Holistiplan, which is our tax planning software we use for clients as we make projections out for this year and years going forward from a tax standpoint and also optimize for opportunities. So we were able to dive into there as early as this week and start to run some of those projections for our clients to see how it actually impacted them and their tax situation. So just a quick FYI before we dive into the whiteboard. This is not a comprehensive breakdown of all of the key changes from OBBBA. I'm actually going to be recording a podcast for that one. It's going to be coming out next Tuesday. So make sure to subscribe to our YouTube channel, of course, but also follow our podcast if you are nearing retirement or have recently retired and you're interested in learning more about these changes and how they will impact you, PFR Nation. So I quickly want to touch on the main issue we're going to be hitting on today in this Whiteboard Fireside Chat. And it's really related to the standard deductions, but also this bonus deduction for folks that are 65 or older by the end of this year. Okay. So under the current law for 2025, single individuals would receive a standard deduction of $15,000. So essentially this means you didn't have enough in itemized deductions to exceed $15,000. So therefore you're just going to take the standard deduction. And this was one of the key provisions in the Tax Cuts and Jobs Act that was passed back in 2017 that came into law in 2018 that was supposed to sunset at the end of 2025 unless the OBBBA was passed. And so that was a big deal because ultimately these standard deductions would have reverted back to their old rules, which was about half of this and of course adjusted for inflation. So a big deal with regards to the standard deduction, and married filing jointly was $30,000 for 2025. This is pre-OBBBA, okay? And I call this current law, this is pre One Big Beautiful Bill Act, or OBBBA, okay? Now, there was also a bonus deduction. If you were 65 or older or blind, you had an additional deduction, okay? And so if you were single or not a surviving spouse, it was $2,000. If you were married, it would be $1,600 per individual, okay? So for a total of $3,200. Now, this is in addition to the standard deduction, okay? So if you're in this situation, if you're married filing jointly, which this couple that we're going to break down is, they would receive $30,000 plus an additional $1,600 each for a total of $3,200. So their standard deduction would have been $33,200. Okay, this was pre-OBBBA. All right. Now, the final legislation that was passed on July 4th, Independence Day, essentially gave a slight inflation adjustment to the standard deduction. So not only did it continued at that doubled standard deduction rate relative to the 2017 limits, okay, the standard deduction limits. They also gave a slight additional deduction. So for singles, it was $15,750. For married filing jointly, it was $31,500. Now, this is the key. In addition to this bonus deduction for folks that are 65 or older or blind, there's also now just another bonus deduction. It's actually technically a personal exemption, but kind of look at it as in addition to your standard deduction. It's more money to reduce your taxable income, or your adjusted gross income, and obviously reducing your taxable income. So in 2025, and this does sunset at the end of 2028, mind you, so this is not permanent. The standard deduction double was made permanent, okay? But this is not permanent. This additional deduction for folks that are over the age of 65. Now, instead of the $1,600 for married couples, and then the $2,000 for non-married couples or non-married taxpayers. Now we have $7,600 if you are married filing jointly, or $8,000 if you are not married and you're filing single. Okay, so this 7,600, this is per person. So multiply that by 2. Obviously, if you're married filing jointly, now we're at a total of about 15,200. Okay, so for this particular couple, they're married filing jointly 31,500, but they're also over the age of 65, so they're getting that additional bonus deduction of $6,000 on top of what was currently in place. Okay, so now we have a total of 15,200 on top of this 31,500. Now they're getting to deduct 46,700 if they are taking that standard deduction. If they don't take the standard deduction, they can still itemize, and they will also be eligible for that bonus deduction. But this particular couple we're going to break down, they are eligible, they are not eligible to do itemize because they just don't have enough deductions. Okay, they have no mortgage, their medical expenses are fairly low. They don't donate a whole lot to charity relative to what they could deduct from a standard deduction perspective. So they're just going to take this, but that is a significant tax deduction straight off the bat. Now let's actually funnel this in to holistic planning. What we're going to do is we're going to break down 3 scenarios. We've got, for fun, I wanted to break down scenario 1 here. Hopefully this isn't too hard to read, but this is essentially what the rule would have been in 2026, or the tax brackets would have been in 2026, if the Tax Cuts and Jobs Act had sunsetted. And I think this is probably the most important thing. Out of all of the new legislation, yes, there's a lot of new legislation in here, a lot of smaller details that certainly add up to add value to most taxpayers in the U.S. But the biggest one was not having the Tax Cuts and Jobs Act sunset back to the 2017 rules. Okay, I think that was the biggest thing out of all of this, because the tax brackets remained intact relative to where they are today versus what they were pre-2017, which are lower for most taxpayers. And then we have the standard deduction limits, which I just talked about as well. But for fun, I wanted to run that as scenario 1. Scenario 2, we had pre-July 4th, so pre-OBBBA being signed in, and I forgot the A there at the end on this tax scenario, so OBBBA. So anyway, so that's OBBBA. And then scenario 3 over here is now with OBBBA intact, okay? And we're going to funnel their income sources through our tax planning software to see what the impact was net after all of these deductions were put in place. But as you can see with this couple, they have pensions, okay, and they total $32,000 per year roughly, and they have gross before taxes Social Security of $67,200. Now, as you can see here, this taxable Social Security, not all of their Social Security is taxable, okay? So one of the things that I would highly encourage you to do when you're thinking about when to claim Social Security is to look at, how much of your Social Security will be taxable during each phase of your retirement? Because there could be an argument, there could be opportunities that come about, and I talked about this in one of my Whiteboard Fireside Chats, to essentially get aggressive with some of those conversions, getting so aggressive with some of those Roth conversions during your Roth conversion window to essentially pay those taxes, delay your Social Security, because you don't want that to be destroyed with taxes during that period of time. And oh, by the way, you're going to be compounding and increasing your Social Security benefit by delaying until 70. Then once you turn 70, let's say most if not all of your assets are now converted to Roth. Now those distributions are going to be tax-free. And now when you do start taking Social Security, some or all of your Social Security could be exempt from taxes altogether. Okay, so that rule has not changed. There are still tiers in terms of how much of your Social Security is taxable. In this case, about 80% of their Social Security is taxable, okay? So the maximum you can have as taxable is 85%. They are close to the maximum, but not yet at that max. But as you can see, total income, between those two guaranteed income sources, in the neighborhood of about $99,000 is guaranteed income. Super powerful when you think about long-term planning, because this is not tied to the market. It's not tied to stocks and bonds going up and down with any volatility or with any uncertainty. But they do need additional income. And I mentioned earlier, they have about 1.5 million in retirement assets. 99.9% of this is in tax deferred vehicles. Okay, so for this particular couple, they saved mostly in pre-tax accounts, which is a lot of the clients that we serve that are approaching or have recently retired. They took advantage of their company 401k or company 403b. They were making contributions. Maybe they didn't even allow for Roth contributions into that plan, but all of a sudden they get to retirement and most, if not all, of their investment assets are in pre-tax accounts. So in this case, those distributions, those IRA distributions, will be fully taxable. And I funneled this in. I made it, equal across the board. So as you can see, in all three scenarios, we have the same income sources plugged in to keep things apples to apples. Even though I recognize in the scenario one, we're looking at the 2026 tax law in terms of the Tax Cuts and Jobs Act sunsetting. I just wanted to keep things apples to apples just for this Whiteboard Fireside Chat video. As you can see, taxable interest here, not a substantial amount. They don't keep a huge amount in cash accounts, maybe $40,000, $50,000. And, they do earn a little bit of interest income. So one of the planning opportunities that we do see oftentimes is that, our clients, they get to retirement and all of a sudden they have a large cash position. Maybe they sold their primary home and they're just sitting on a bunch of cash that's earning now 4.5% interest. All of a sudden, that's multiple tens of thousands of dollars that they're earning for taxable interest. This adds a tax drag on their overall plan because yes, they may be getting 4.5%, but that's added into your total income, which impacts things like taxable Social Security. It impacts things like how much room you have in each tax bracket. It impacts things like, how much can you do for capital gains before you get to the 15% bracket versus staying in 0%. So there are things that taxable interest does impact. So just kind of be careful with that. For this particular client, they've done pretty well to keep a minimal amount in cash and they keep most of their assets invested within these tax-deferred IRAs. And they do make that withdrawal from their IRA on a monthly basis, this $33,000. So just for fun, I just want to point out, let's take this number here and let's divide that into the 1.5 million. Okay, that gives us the total rate of withdrawal for this year, 2025. And that amount is about 2.22% annually, well below the benchmark of 4%. So as you can see, this couple, they have the capacity to spend more, but they're doing what they want to do when they want to do it, particularly because that guaranteed income coming in from their pensions and from Social Security. So now we have their total income plugged in, their adjusted gross income. So I mentioned scenario one, sunsetting back to the old rules, the Tax Cuts and Jobs Act. So the standard deduction would have gone down for them, down to $19,700. Okay. Scenario two, which was pre-OBBBA, now the standard deduction is $33,200. I think before the Tax Cuts and Jobs Act, it was somewhere in the neighborhood of about 60 to 70% of taxpayers that actually took the standard deduction. Now it's closer to 90% or even higher of taxpayers taking the standard deduction. So it has simplified the tax code. It resulted in a lot of people just self-filing because they're like, what do I need to pay a tax preparer if I'm just essentially taking the standard deduction? I'm not itemizing anything. But nonetheless, this standard deduction change is big. But the bigger ones, like I mentioned, a couple of things. Number one was that additional standard deduction, that inflation adjustment on the standard deduction. So this did increase with the OBBBA being passed on July 4th. But remember that bonus deduction, because there are two people over 65, okay, they get $6,000 per person times 2 equals $12,000 as what we're calling this as an other deduction or an additional deduction or a bonus deduction. Okay, so this is a big deal. What you will notice here with scenario one is you can see this exemption amount of $15,900. This was a personal exemption amount based on the number of people in your household pre-Tax Cuts and Jobs Act that this was in place. And I think the amount was about $4,000 and some change per taxpayer. They actually have 3 people on their tax return. The 2 of them, the married couple, our client, and then the one of the spouse's moms also lives with them, and they claim her as a dependent on their tax return. So they would have received a personal exemption of about $15,900. So that is a factor. If you look at the standard deduction, yes, it went down in the pre-Tax Cuts and Jobs Act rule, but that personal exemption would have come back. So that is a big factor just to kind of keep in mind that, yes, the standard deduction is much higher, but those personal exemptions are no longer anymore. Okay, as you can see, We have 0 in scenario 2 and then 0 in scenario 3. So let's see, what does that result from a taxable income standpoint? As you can see, scenario 1 actually resulted in a lower taxable income than scenario 2. So even though the tax cuts expired in scenario 1, the taxable income went down because of those personal exemptions, because they have 3 people in the household. So the more people in your household, the more advantageous that old rule was pre-2017 Tax Cuts and Jobs Act passing. However, like I mentioned, the marginal brackets, they're made permanent. So now we have 12% versus the old rule at 15%. So we don't have to worry about this anymore, like I mentioned, but I just wanted to compare this apples to apples. Now, there is an additional deduction you can receive, or a tax credit you can receive for any taxpayer that is over the age of 18. So, typically, if you have a dependent on your tax return, but they are they are under the age of 18, you're going to get a child tax credit. In this case, mom is not a child; she's over the age of 18, but they do receive a non-refundable credit in all 3 scenarios of $500. Okay, so we've got that baked in across the board. But look at this. Look at that scenario 3. Because of those additional bonus deductions, that's $6,000 per person, that slight adjustment to that inflation for the standard deduction, taxable income is way down over here in scenario 3 relative to scenario 1 and scenario 2. And if you look at the total tax paid, this is what we're talking about here. We would have had $10,963 with the Tax Cuts and Jobs Act sunsetting. We would have $9,450 with the current law with the law pre-OBBBA, and then with OBBBA, $7,830. So look at that. Significant tax savings, especially when you compare that to the Tax Cuts and Jobs Act sunsetting in 2026 or at the end of 2025. So even though scenario 2 had the highest taxable income, it still resulted in lower taxes because of this 12% bracket relative to that 15% bracket that they would have been. And then again, the effective rate is really what we care the most about. Yes, the marginal bracket is important, but that effective rate is what we care about most. This is in effect what they are paying on each dollar of income from a tax standpoint. So it's not, even for this client here, even though they were in the 15% marginal bracket here, their effective rate was 13. Even though they were in the 12% marginal bracket here in the scenario 3, their effective rate only 10.7%. So big tax savings there. And if you really look at the dollar number or the dollar amount here, it's about a $3,133 savings compared to if the Tax Cuts and Jobs Act had sunsetted. So big deal, for seniors, for folks that are over the age of 65, because of that additional inflation adjustment to the standard deduction, because of that bonus deduction for seniors that are 65 or older. So here are 3 opportunities to consider for a couple like this. If you're in a similar scenario, most of your assets are in these tax-deferred vehicles, you've got a sizable amount there. Maybe you're not withdrawing an aggressive amount currently, but you're currently in that Roth conversion window. Number 1, I would say, is spend more, enjoy retirement. You just got a nice little tax break, take an extra trip. Do that extra cruise, maybe fly first class, whatever it might be that's going to give you more fulfillment and enjoyment today, whatever that might be, pursue that. Okay. This is benefiting you. Number 2, I would say, is fill up those current tax brackets. If you're like, Kevin, I'm already taking the trips I want to take. I don't want to travel more. I'm already, taking all the golf trips I want to take, whatever that might be. Fill up those current tax brackets with more income. You're going to have more room for either a distribution in whatever current bracket you're in, or additional room for Roth conversions if that is something that aligns with your long-term plan. I'm not saying just convert just because of the OBBBA pass, but I'm saying if Roth conversions were important to you and were part of your long-term strategy and you're in that Roth conversion window sweet spot, you have more room to now max out because your taxable income is much lower. You have more room at that current bracket. Number 3 is going to be capital gain harvesting. So depending on your taxable income, you're either going to pay 0%, 15, or 20% on capital gains. So in this particular scenario, this couple, now they didn't have any long-term capital gains because they don't have any assets in the taxable brokerage account. But if they did, and if you do, you actually could have room to do some distributions from that taxable account and stay at that 0% capital gain level, because again, they look at your taxable income. okay, not your adjusted gross income. So really great opportunity for what we call tax gain harvesting, or just simply taking those distributions and using some of those distributions as income in lieu of IRA withdrawals. So the bottom line is no. The new Trump bill did not make your Social Security tax free, okay? Contrary to what a lot of people believe, but OBBBA absolutely did benefit seniors over 65, especially in those lower to middle income thresholds, okay? And again, make sure to subscribe, follow the podcast, subscribe to the YouTube channel, because next week I'm going to be doing a full detailed breakdown on some of those changes. Not every change, because not all of them apply to PFR Nation, but for folks that are in that PFR Nation sweet spot, you're over 50, certainly, probably approaching 60 more so, and the majority, if not all, of your assets are in these tax deferred vehicles, and you're looking to maximize your retirement spending, minimize your lifetime tax bill, and worry less about the financial markets. I'm going to be hitting on those details that impact you specifically. So stay tuned for that one. If you like the video, make sure to give it a thumbs up. It helps our content. It helps us reach more people. It tells the algorithm, hey, this was helpful. Let's share this with more people like you. If you're watching this video and you're like, okay, I would love some help on figuring out, okay, how does this impact my retirement plans? How does this new tax legislation impact my ability to maximize spending, minimize my lifetime tax bill, and worry less about the financial markets? We do work with clients one-on-one. This is what we do on a day-to-day basis. And so if you're interested, you can visit our website directly at www.imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that's linked in the description. We just want to learn more about you, what's important to you, what you're trying to accomplish, and see how we can help you as you approach and execute a successful retirement. Thank you so much for watching. I'll see y'all next week.